Okay, let's unpack this. Our deep dive today, it's a really rigorous look at this whole real estate paradox. You know, how the dream of building wealth with hard assets bumps up against, well, the nitty-gritty of financial analysis.
Hmm.
We've pulled together a ton of sources, everything from like the classic economics books and value investing guides to really modern stuff on tax loopholes and negotiation tactics.
And the mission here for you is pretty specific. We're aiming to go way beyond just, buy some property advice.
Right.
This dive is really about giving you that strategic roadmap for investing. We're focusing on the calculation, really leverage, how to analyze assets, managing risk. That's the knowledge that separates, someone just dabbling from a serious investor.
Exactly. The goal is connecting that big picture why build tangible wealth with the practical step-by-step how. How do you actually evaluate a deal? How do you scale up?
Yeah.
We want you armed with an understanding of these concepts, things like positive leverage, using the tax code smartly, forcing appreciation that the real pros use day in, day out.
We're going to try and show you how to spot and use the advantages baked into the hard asset market. And, importantly, why doing that rigorous objective analysis is, honestly, the only way to avoid kicking yourself later.
So let's start high level. Looking at the mechanics of economic success itself, the source material keeps coming back to this powerful idea that the system, market competition, systemic effects often matters way more for outcomes than, say, the good intentions or motivations of the people involved.
That's a really foundational concept, and it's interesting because you see it across the board in economic thought.
Mm-hmm.
I mean, think about Adam Smith, right? Founder of classical economics. Then compare him to someone like Karl Marx, the big critic of capital. Totally different philosophies, obviously.
Worlds apart.
Exactly. But they both essentially agreed that economic outcomes are driven primarily by the system's mechanics, not necessarily by whether individuals are good or bad.
Yeah, Smith's whole invisible hand idea, right? It suggests good social outcomes happen when people pursue their own interests, sometimes even if their intentions aren't noble. He actually wasn't very complimentary about businessmen and the wealth of nations.
Not at all.
But he still pushed for free markets because he thought the system, the competition, would sort of automatically drive down prices and improve quality.
And Marx, on the other side, his critique was aimed at the system of capitalism itself, the exploitation baked in. He wasn't just saying capitalists are greedy. He saw that the system forces them to maximize profit, often at labor's expense, just to survive against competitors.
Okay, so bringing that down to investing.
It translates directly. Your success as an investor isn't about betting on someone's good nature like a seller being nice. It's about understanding and mastering the system. Supply and demand curves, regulations, how financial leverage works.
Yeah.
That's the game.
And if the system's the main thing, then, well, one of the biggest hurdles investors face seems to be just getting started. The sources talk a lot about the cost of doing nothing, that someday mindset.
Oh, that someday mindset is absolutely lethal for building wealth. The idea that you'll start learning or saving or investing someday when things are perfect.
Right, when the stars align.
Yeah, which they never do. It just leads to putting things off, habitual failure, and then down the road, massive regret.
Yeah.
Behavioral finance tells us the antidote is action. Immediate, targeted action.
Just do something.
Exactly. Commit to that first step, that first investment, even if it's small.
Yeah.
Because action, honestly, it cures fear and regret way better than reading yet another book about it.
And then even when people do act, the data shows this brutal timing penalty if emotion takes the wheel instead of, solid analysis.
Classic behavioral trap. The data is so consistent on this. Your average mutual fund investor gets returns that are way, way below just buying and holding an index fund.
Why is that?
Because they're always trying to time the market. They wait until things feel safe, which means they pile in after the market's already gone up near the top, right, when everyone's enthusiastic. And then they panic when the news gets scary and pull their money out near the bottom, locking in losses. Fear takes over.
We saw that play out so starkly in 2008, 2009 during the financial crisis.
Oh, absolutely. Right when the market hit rock bottom in early 2009, the news reports confirmed it. Retail investors yanked more money out of stock funds than ever before.
Selling at the absolute worst time.
Catastrophic timing penalty, driven purely by emotion. If they just held on, or even better, put more money in during that dip, they'd have captured that huge recovery that followed.
So the lesson from the system is base your decisions on objective value, on the long-term mechanics, not on how you or the market feels today.
Precisely. And that objective analysis demands a really clear understanding of risk. Let's maybe contrast the two main ways people think about financial risk because they're fundamentally different.
Okay, yeah, let's do that.
All right, the first one is the traditional academic definition. You often hear it called beta. This basically defines risk as volatility, how much a stock price has bounced around in the past.
So wild swings mean high risk.
According to that model, yes.
Mm-hmm.
It's purely a measure of past price movement.
Okay, what's the second definition?
The second one, which value investors really focus on, defines risk differently. It's about the probability and the potential amount of permanent loss of your capital. Not just volatility, but actually losing your money for good.
And how can those two conflict? That's the interesting part.
Right. So imagine a company whose stock price is cratered, maybe dropped 70% because of market panic. According to the first definition, it's super volatile, high beta, therefore high risk.
Okay.
But a value investor looks deeper. They ask, has the actual underlying business value dropped 70% permanently? If the business itself is still fundamentally sound, that massive price drop might have actually eliminated most of the real risk.
How so?
Because the potential for it to fall much further is now minimal, while the potential upside, if the market recognizes the value eventually, could be huge.
So under that second definition, something really volatile but deeply undervalued could actually be a low-risk investment.
Exactly. Volatility is about price swings. Risk, in this sense, is about the chance of permanent loss.
Okay, that makes sense.
So the core idea we're pulling from the sources here is that good financial management isn't about chasing returns. It's about managing risks, controlling the odds, and the amount of potential loss. You take care of the downside, the upside often handles itself.
All right, so taking that focus on risk and systems, let's apply it directly to hard assets. Let's shift gears fully into real estate now. Why is income-producing property, structurally different as a way to build wealth?
It really is unique, mainly because it can give you 4 different types of return streams all at the same time. We often call these the 4 pillars of real estate return.
Okay, let's break this down. Pillar number 1, the immediate one.
First up is cash flow. Pretty straightforward. This is the actual money left in your pocket after you've paid all the bills, operating expenses, property taxes, insurance, and importantly, the mortgage payment, the debt service. It's the profit you get today in cash.
Got it. Pillar 2.
Second is appreciation. This is the increase in your equity because the property's overall market value goes up. This is more tied to the broader economy, the local market trends, the macro factors.
Okay. And the third one? This one sometimes gets overlooked.
Yeah, loan amortization. This is also equity growth, but it comes from paying down the mortgage principal month after month. Here's the kicker. Your tenant's rent payments are typically covering that mortgage payment.
So they're essentially buying the asset for you over time.
In a way, yes. You borrow the money, but the income from the asset pays off the loan, steadily building your ownership stake, your equity. If you put, say, $100,000 down, and in the first year, $5,000 of your mortgage payments goes toward principal reduction, well, you just made $5,000 in equity and your tenants funded it.
Nice. Okay, and the fourth pillar, this one seems particularly powerful, especially in the U.S.
Definitely. It's tax shelter. This is the property's ability to legally shield some, or potentially all, of the income it generates from taxes. Sometimes it can even shelter income from your regular job. Yeah. And when you add up these 4 returns, the cash flow you get now, the potential appreciation, the forced equity buildup from loan paydown, and the tax savings, the total return, often blows away what just the cash flow number suggests. That's why real estate can be such a powerful engine.
And circling back to that risk discussion from part 1, you stressed real estate as a hard asset.
Yeah.
What's the significance there compared to, say, stocks?
It's a critical distinction. Paper assets, stocks, bonds, they can theoretically go to zero. A company go bankrupt, its stock worthless.
Right.
But a piece of land with a building on it, it always has some inherent residual value. The land itself, the physical structure, even if damaged.
Yeah.
There's a tangible floor there that limits how much capital can be truly impaired, which is fundamentally different from purely paper investments.
Okay, that makes sense. Now let's talk about control. With most investments, like stocks, you're kind of waiting for the market pillar 2, appreciation, to lift the value. But real estate offers something called forced appreciation. How do investors actually do that?
Right. Forced appreciation is about actively increasing the property's value yourself, usually by boosting its net operating income, or NOI. You do this through direct actions that you control.
Like what?
Things like doing strategic repairs or renovations, maybe not a full gut job, but smart upgrades. Painting cabinets instead of replacing them can have a huge ROI, for example. Or improving the property management, finding better tenants, reducing vacancies, cutting unnecessary expenses.
Hmm.
Unlike owning a stock, you're not passive. You can actively manage the asset to make it more valuable.
And this idea, forced appreciation, is really central to that BRRR strategy people talk about. Buy, rehab, rent, refinance, repeat. Why is BRRR seen as better for scaling up quickly compared to just buying, renting, and holding?
The magic of BRRR is really in those last two R's, refinance and repeat.
Yeah.
It's a superior way to get your capital back out.
How does that work?
Okay, so you buy a property that needs work, usually below market value. Then you rehab it, that's the forced appreciation part, adding value immediately. You get it rented out. Then, crucially, you go back to the bank for a refinance. But now, the appraisal is based on the new, higher after repair value, ARV.
Ah, so the bank will lend more.
Exactly. Because the property is worth more, the lender is willing to give you a larger loan. The goal is often to pull out most, if not all, of your original investment, the purchase price plus the rehab costs.
So you get your money back to go do it again.
Precisely. Let's say you put in $100,000 total for the purchase and rehab. After it's fixed up and rented, it appraises higher, and the bank lets you refinance and take out, say, $90,000 in cash. You've effectively recovered most of your initial capital.
Oh.
You still own the cash-flowing asset, you've locked in the equity gain, and you've got $90,000 back to go find the next deal. It lets you recycle your capital and scale your portfolio much faster than saving up a new down payment each time.
Okay, this leads perfectly into the engine behind a lot of this rapid growth leverage. This is where it gets really interesting, as you said. Give us the simple definition of leverage.
Leverage basically is using borrowed money debt to buy an asset. The key is expecting that the asset will generate a total return from all those four pillars we mentioned that's significantly higher than the interest rate you're paying on the loan.
And why is real estate so special when it comes to getting leverage? Why can ordinary people borrow so much?
It comes back to that hard asset idea. Lenders see loans secured by physical real estate as relatively safe. If things go wrong, they can foreclose and recover the property.
Okay.
That security is what allows an average person, not just billionaires, to borrow substantial amounts, often 75% or even 80% of the property's value. You might get a $400,000 loan based more on the property itself than just your personal income or net worth. Banks feel comfortable with that collateral.
Which brings us to the term positive leverage. What is that?
Positive leverage is the sweet spot. It's when the total rate of return your property is generating again, combining cash flow, appreciation, loan paydown, tax benefits, is higher than the interest rate you're paying on your mortgage.
So the borrowed money is making you more money than it costs.
Exactly. If your loan costs you 5% interest, but the property is kicking off, say, a 12% cash-on-cash return plus other benefits, then every dollar you borrowed is amplifying your profits. You're making more money because you borrowed than if you'd paid all cash. That difference is the amplification effect.
Because leverage is a double-edged sword, right?
Right.
That's the danger. Let's talk about negative leverage.
Absolutely critical risk to understand. Negative leverage is the opposite situation. It's when your cost of borrowing the interest rate is higher than the cash-on-cash return the property is generating.
So if you borrow at 8%, but the property only yields 6% cash flow.
Then every dollar you borrowed is actually costing you money each year, just on the cash flow side. Now, you might still be gaining equity through appreciation or loan paydown, but the property isn't generating enough cash to cover its own debt service comfortably. It's actively draining your reserves.
And if you're highly leveraged in that situation,
It can be disastrous, especially if you rely on that cash flow or if there's an economic downturn. High negative leverage can quickly lead to inability to pay the mortgage, potential bankruptcy, or being forced to sell the property at a bad time.
so the goal is always strong cash flow and managing that debt to stay in positive leverage territory. Okay, this connects perfectly to the tax system, which can help here. Let's start with that unique deduction, depreciation.
Depreciation is fundamental to real estate tax benefits. The IRS lets you deduct a portion of the value of the building, not the land, just the building each year. The logic is that the building is theoretically wearing out over time.
Even if you're maintaining it well.
Yes, it's a non-cash expense. It's just on paper. So let's say your property actually produces $15,000 in positive cash flow, but the IRS allows you to deduct $10,000 for depreciation that year.
Okay.
You only pay income tax on the difference, the remaining $5,000. The other $10,000 of cash flow comes to you effectively tax-free in that year. That's how you get tax-free income from real estate.
And the sources really hammer home a point about taking that deduction every year.
Crucial. Absolutely crucial. The IRS basically says, we assume you took the depreciation you were entitled to. even if you don't claim it on your tax return, maybe because you didn't owe tax that year anyway.
So what happens if you don't claim it?
When you eventually sell the property, the IRS calculates your taxable gain based on your original purchase price minus all the depreciation you could have taken over the years. If you didn't actually take it, you still get taxed as if you did. You lose the annual tax shelter benefit and end up with a bigger tax bill at the sale. So, rule number 1, always take your maximum allowable depreciation.
Okay. And for investors, maybe in higher tax brackets, there are ways to speed this up. Accelerated depreciation. Tell us about cost segregation.
Right. Cost segregation is a more advanced strategy. You hire specialized engineers to do a study of your property. They basically break down the building into its components.
Instead of just one lump sum building value?
Exactly. Instead of depreciating the whole structure over the standard 27.5 years for residential or 39 years for commercial, they identify components that have shorter lifespans, according to the IRS. Things like carpeting, landscaping, specific electrical wiring, cabinetry. These can often be depreciated much faster, maybe over 5, 7, or 15 years.
And the benefit of doing that, getting the deductions sooner?
It front-loads the deductions massively. You get much bigger depreciation write-offs in the early years of owning the property.
Which means?
For someone with high income, maybe from a job or another business that's taxed at a high marginal rate, say 45%, these large paper losses from accelerated depreciation can offset that high taxed income. It significantly reduces their current tax bill.
But isn't it just deferring the tax? Don't you have to pay it back when you sell?
Yes, the depreciation you took gets recaptured at sale and taxed. But here's the potential arbitrage. The recapture is typically taxed at a specific lower rate, currently capped around 25%. So you might offset income that was taxed at 45% with a depreciation loss and then effectively repay that tax benefit later at only 25%, that 20% difference. That's permanent tax savings, not just deferral.
Wow, okay. That's clever. Now, to avoid paying that recapture tax at all when you sell, people use the 1031 exchange. What is that and what are the rules?
The 1031 exchange, named after Section 183(1) of the tax code, is incredibly powerful for building wealth over time. It lets you sell an investment property and defer paying all capital gains tax and depreciation recapture tax, provided you reinvest the proceeds into another like-kind investment property.
Like-kind, meaning?
It's actually pretty broad for real estate. You could exchange raw land for an apartment building or an office building for a rental house. The key is that both are held for investment or productive use in a trade or business.
And the power's in the compounding.
Exactly. You roll your entire pre-tax proceeds from the first sale into the next, usually larger property. Your equity grows tax-deferred, allowing you to compound wealth much faster than if you had to pay taxes after each sale.
But there are strict timelines, right? You mentioned a clock running.
Extremely strict. This is where people get tripped up. Once you close the sale on the property you're selling, the relinquished property, you have only 45 days to formally identify potential replacement properties, usually in writing to a qualified intermediary.
Only 45 days to find the next deal. That's tight.
Very tight. And then you must actually close on the purchase of one or more of those identified properties within 180 days from the date you sold the original one.
And if you miss those deadlines by even one day,
the entire exchange fails. All the deferred taxes, capital gains, and depreciation recapture become immediately due in that tax year. No exceptions. It requires careful planning.
Definitely. Okay, one more tax strategy, using retirement accounts. Self-directed investing. How does that work with real estate?
This is another really potent strategy. You can set up a self-directed IRA, SDRA, or solo 401k that allows you to invest your retirement funds in alternative assets, including direct ownership of real estate.
So your IRA actually buys the rental property?
Yes, the IRA itself, or an LLC owned by the IRA, becomes the legal owner. If it's a Roth IRA, the implications are huge.
So with a Roth.
Because with a Roth, all the qualified growth and distributions in retirement are completely tax-free. So imagine your Roth IRA buys a property. All the rental income it collects flows back into the Roth, tax-free. When the Roth eventually sells the property, maybe for a big gain, that profit is also tax-free inside the Roth.
So all the cash flow, all the appreciation, totally tax-free forever.
If held within the Roth and withdrawn according to the rules in retirement, yes. Tax-free rental income, tax-free capital gains. It allows you to take active real estate returns and shield them entirely from taxation using the retirement account structure. It's a massive long-term advantage compared to investing in real estate through a regular taxable account.
Okay, let's shift from the system mechanics and tax rules to actually doing deals. The sources emphasize that a professional investor's job isn't just buying stuff. It's more selective.
Absolutely. It's not about buying the first property that seems okay. The pro operates like a funnel. You look at tons of potential deals, maybe hundreds,
The top of the funnel is wide.
very wide. Then your real job becomes rigorously disqualifying as many of those properties as possible, as quickly as possible. You run initial numbers, filter out the obvious non-starters, maybe you do some basic analysis on 20 or 30, then you dig deeper, do serious due diligence on maybe 5 or 10.
And only buy one or two.
Right. You filter and filter until you're left with only the very best deals that actually meet your strict investment criteria. It's about quality control and avoiding mistakes, not just volume.
So this implies the purchase price isn't just about what the seller is asking. It's driven by the buyer's needs.
That's the crucial analytical mindset shift. A serious investor doesn't start with the asking price. They start with their required rate of return.
Okay, explain that.
They model the deal. They project the likely cash flows year by year, estimate the operating expenses, vacancy rates, and then project a potential sales price years down the road. They plug all that into their spreadsheet.
Then what?
Then they essentially work backwards. They ask, what's the maximum purchase price I can pay for this property today and still achieve my target return? Whether that target is a specific internal rate of return, IRR, or a cash-on-cash K return, or an equity multiple. They slide the purchase price number up or down until the model spits out their required return.
So if the seller's asking price is higher than that calculated maximum,
Then the deal doesn't work on paper.
Yeah.
You either have to negotiate the price down to your number, find ways to increase income or decrease expenses in your model, or you simply walk away and move on to the next deal in the funnel. The return dictates the price, not the other way around.
to make those calculations accurately, investors need the right tools, the right metrics. Let's talk about the essential ones, starting with the absolute bedrock of commercial property analysis, net operating income, NOI.
NOI is king. It's the property's profit before you factor in debt payments, the mortgage, or income taxes or big capital improvements.
How do you calculate it?
You take your total potential rental income, subtract allowances for vacancy and tenants not paying, credit loss, and then subtract all the cash operating expenses required to run the property. Things like property taxes, insurance, utilities if paid by owner, routine maintenance, property management fees, everything except the mortgage payment.
And why is leaving out the mortgage payment so critical for analysis?
Because it lets you compare properties on an apples-to-apples basis, regardless of how the buyer finances it. Property A might be bought with 50% debt, property B with 80% debt. Their final cash flow to the owner will look very different because the debt payments are different.
Right.
But if they have the same rental income and the same operating expenses, their NOI will be identical. NOI tells you about the property's intrinsic operational performance, separate from the owner's financing choices. It's the pure earning power of the asset itself.
Okay, crucial metric. Next, we need to bring in time. Annualized ROI. Why isn't simple ROI enough?
Simple ROI just tells you profit relative to investment. I made $10K on $100. That's 10% ROI. Okay, great. But did that take you 6 months or 6 years? Makes a huge difference.
Time is money.
Exactly. Annualized ROI accounts for the holding period. The faster you generate the return, the higher your annualized return. Using that BRRR example, if you get your capital back out plus a profit in, say, 8 months instead of holding for 3 years, your annualized ROI skyrockets. It rewards efficiency and velocity of capital. Results increase dramatically as the time to get the return shrinks.
Makes sense. Now, for quick mental math, especially thinking about compounding over the long haul, there's the rule of 72.
Yeah, great little shortcut. Super useful. You just take the number 72, divide it by your expected annual compounding rate of return as a percentage, and the answer is roughly how many years it'll take for your investment to double. Sure, if you think an investment will consistently return 8% per year, compounded, 72 divided by 8 equals 9. So your money should roughly double every 9 years at that rate. Quick and easy estimate.
Love that. But for more complex deals, especially ones with cash flows spread out over many years, you need something more sophisticated that accounts for the time value of money. Enter net present value, NPV.
NPV is absolutely essential for serious deal analysis, especially larger projects. The core idea is simple. A dollar today is worth more than a dollar you expect to receive 10 years from now.
Because of inflation and opportunity costs.
Precisely. NPV takes all the projected future cash flows from an investment annual income, proceeds from the eventual sale, and discounts them back to what they're worth in today's dollars using a specific discount rate.
Oh, wait, tell me about the discount rate. How do you pick that?
The discount rate is basically your required rate of return, or your opportunity cost. What return could you reasonably expect to get on that money if you invested it elsewhere with similar risk? If you think you can reliably make 10% elsewhere, You might use 10% as your discount rate for this real estate deal.
And how does the NPV calculation help you decide?
You calculate the present value of all the expected future positive cash flows using your discount rate. Then you subtract the initial investment cost, the purchase price plus upfront rehab, etc. If the result, the NPV, is positive, it means the projected returns, discounted back to today, are greater than the initial cost. The deal theoretically meets or exceeds your required rate of return.
And if NPV is negative?
If the NPV is negative, it means that even with all the projected future income, the deal doesn't meet your required return threshold when considering the time value of money and your opportunity cost. It suggests you'd be better off putting your money into that alternative 10% investment. NPV forces that disciplined comparison.
So relying just on simple metrics like first-year cash-on-cash return isn't enough for bigger, longer-term plays. You need the rigor of NTV.
Definitely. It prevents you from getting seduced by a deal that looks okay in year one, but has weak long-term prospects when properly discounted.
Okay, shifting from analysis to actually buying. Once you make an offer, what's the crucial safety net you need?
Absolutely non-negotiable.
Yeah.
A due diligence contingency clause. This has to be in your purchase offer.
What does it let you do?
It gives you, the buyer, a specific period of time after the offer is accepted, maybe 15, 30, 60 days, to thoroughly investigate every aspect of the property. Physical inspections, structural, electrical, plumbing, roof, HVAC, environmental checks, reviewing all the leases and financial records, checking zoning, everything.
And if you find something you don't like?
If your investigation turns up problems, maybe a major hidden repair needed, or the income numbers aren't what the seller claimed, the contingency clause gives you the legal right to back out of the deal and, crucially, get your earnest money deposit back. It's your escape hatch if the reality doesn't match the initial promise.
Essential protection. Okay, assuming due diligence goes well, now you negotiate. What's the professional approach?
First, preparation is everything. You must know the true market value before you make an offer. That means doing your homework. Detailed rent surveys for comparable units in the area, pulling recent comparable sales data comps. Never go into a negotiation blind. Know what it's realistically worth.
And then the strategy in the actual back and forth.
The pros often negotiate the less critical items first. Things like, who pays for minor repairs found during inspection, whether certain appliances stay or go. You might make some small concessions here.
I'll do that.
It builds momentum. It gets both sides used to saying yes, gets paperwork flowing, creates a sense of progress towards closing the deal. Both parties become more invested in making it happen.
And save the big stuff for last.
Exactly. You tackle the major points, usually the final purchase price and maybe key financing terms or major repair credits towards the end, leveraging the momentum and goodwill you've hopefully built up.
Makes sense. Lastly, on the management side, after you own it, dealing with tenants, the sources seem united on being firm but fair.
Absolutely. Fair housing laws are paramount.
Yeah.
You must treat every applicant and tenant equally and never discriminate based on protected classes. That's non-negotiable legally and ethically.
Right.
But within that framework of fairness, you also need to be firm and consistent, especially about the lease terms and, most importantly, rent payment.
What's the risk of being too lenient on late rent?
It's a slippery slope.
Yeah.
If you let a tenant slide on a late fee once or accept partial payment without enforcing the lease terms, you're effectively teaching them that rent isn't their top priority payment.
They'll pay other bills first if they know you're flexible.
Precisely. You have to run it like a business. Stick strictly to your written policies. If rent is late, immediately serve the legally required notices, like a pay or quit notice, depending on local laws, and enforce the late fees stated in the lease. Those fees aren't meant to be punitive profit centers. They're there to reinforce the seriousness of the rent obligation. It has to be priority number one for the tenant, just like your mortgage payment is priority number one for you with the bank.
Okay, let's zoom out again now. Look at the bigger picture, the macro context. The source material points out something interesting. The U.S. has this really unique historical focus on suburban sprawl, the detached single-family home, compared to a lot of other developed countries.
Yeah, that landscape wasn't entirely accidental. It was heavily shaped by policy over decades. Think about after World War II, the explosion of suburbs was massively fueled by government actions.
Like what?
Well, the Federal Housing Administration, FHA, played a huge role. Their lending standards strongly favored new construction of single-family detached homes, often on the edges of cities. And then, at the local level, you had widespread use of exclusionary zoning.
What did that do?
Things like mandating large minimum lot sizes, prohibiting the construction of apartments or duplexes in certain areas. These were often explicitly designed to keep neighborhoods exclusive and, frankly, keep lower-income people and certain minority groups out. Land use controls were effectively used as social engineering tools.
So the pattern was wealth moving outwards to these protected suburbs.
That was the traditional model for decades. But now we're seeing a significant shift, almost a reversal in some places. It's being called demographic inversion.
Okay, demographic inversion. What does that actually look like?
It means you're seeing substantial earning power, savings, and often younger, educated professionals moving back into central cities. They're clustering in denser neighborhoods, often near transit and amenities. The so-called creative class that drives the modern information economy is increasingly choosing urban living.
And that drives up city property values and density.
Right. But the flip side is what happens in the suburbs, particularly the older inner-ring suburbs that maybe lack the amenities or cachet of the prime urban cores or the newer, wealthier outer suburbs.
What's happening there?
We're seeing poverty rates increase significantly faster in those suburban areas than in the cities themselves. The data cited was pretty stark in the first decade of the 2000s. Suburban poverty went up something like 53% compared to 26% in central cities.
Wow. So a reversal of the old pattern.
It suggests a real sorting is happening. Wealth and high earners have the mobility to choose these desirable, dense urban areas, while lower-income populations are increasingly concentrated in those older suburban areas where housing might be cheaper, but access to jobs and services can be more challenging.
That's a huge macroeconomic shift. And it provides context when we look at the scale of some commercial real estate deals, right? The sheer amount of money involved.
The scale is just mind-boggling sometimes. You mentioned the source material citing the sale of 666 Fifth Avenue in New York City back in 2007.
Yeah, $1.8 billion for one office building.
A record at the time. It just shows the immense amount of institutional capital chasing these prime, hard assets in core locations.
And it also highlights how big players try to manage risk based on these macro trends. The example of Tishman Speyer selling off billions in assets before the 2007 crash.
Right. They reportedly unloaded something like $10 billion worth of property, including major Manhattan office towers, in the lead-up to the crisis. That wasn't luck. That was likely a strategic move based on their analysis that the market was way overheated and risk was becoming extreme.
Which is a perfect lead-in to the final, really critical lesson from that whole subprime crisis era. The danger of flawed assumptions in financial models, especially about risk correlation.
Oh, the models failed spectacularly. The rating agencies, Moody's, S&P, and the investment banks that built those complex mortgage-backed securities, their models had some fundamental fatal flaws.
What was the core error?
Well, two big ones stand out from the sources. First, unbelievable as it sounds, many of the models literally assumed that national home prices could never decline. They couldn't even input a negative number for home price appreciation.
Seriously, that seems insane.
It basically guaranteed the models would fail in a downturn. But maybe even more critical was the second flaw. They drastically underestimated how interconnected the risks were among all those different mortgages bundled together.
They thought the pools were diversified.
Kind of like they treated them like a pool of diverse corporate bonds, where one company failing doesn't necessarily mean others will. They assumed that mortgages in, say, Arizona failing wouldn't be strongly correlated with mortgages in Florida failing. Their models use low correlation numbers, maybe assuming only 30% correlation between the riskier tranches.
But that wasn't reality.
Not even close. When the national housing market turned down and unemployment started rising, it hit homeowners everywhere simultaneously. Those diverse mortgages weren't diverse at all in the face of systemic economic pressure. The actual correlation wasn't 30%, it effectively became 100%. When one part started to crumble, the whole structure collapsed because the underlying economic forces were the same everywhere.
So the models weren't just missing data, they were built on a fundamentally wrong understanding of how systemic risk works in a crisis.
Exactly. And that is perhaps the single biggest takeaway for any serious investor, especially in real estate, which is so tied to broader economic cycles. You can't rely on assumptions of low correlation or perpetual growth when things get tough. History shows that in a real crisis, correlations often go to one. Everything moves together.
The only defense is
Rigorous, independent due diligence. Conservative underwriting, stress testing your assumptions. Don't just trust the model. Understand its limitations and prepare for scenarios where its core assumptions break down.
Okay, so what does this all really mean for you, the listener? We've gone on quite a journey here in this deep dive. We started with that philosophical idea, understanding the market system is more important than individual intentions. Then we got practical, looking at real estate's unique wealth building mechanics, leverage, forced appreciation, the four pillars. And then we dove into the toolkit NOI, NPV, the importance of rigorous analysis.
Yeah, we've tried to show that just knowing this stuff isn't enough. It's about understanding it deeply and then actually applying it. The real core of successful investing, particularly with hard assets like real estate, isn't necessarily about hitting home runs and maximizing every return. It's about diligently, proactively managing the downside risk.
Protecting your capital first.
Exactly. If you are truly rigorous in your analysis, if you understand the numbers, if you use the financing and tax systems strategically, you put yourself in a different category. You're using the system to your advantage instead of just being subject to its whims.
And while those sophisticated tools, like net present value, are powerful, they let you calculate the worth of income streams way out into the future, the ultimate success. Whether it's one rental house or a huge commercial complex, it really seems to boil down to one lesson from history, especially from that 2008 crisis. You have to assume that when things get really bad, those market risks, plunging prices, sudden demographic shifts, evaporating liquidity, they are 100% correlated. They all hit at once.
That's the conservative, realistic assumption.
So the only real defense isn't a fancy model that assumes things stay normal. It's that rigorous due diligence. It's questioning every assumption about endless growth, and it's building your strategy defensively. Hopefully you now have more of the tools, the metrics, and that strategic framework to do just that. Go out and apply the calculus.